Rising inflation has been a headline in the financial press in the last couple of months. And with increasing household costs, I think it is safe to say we already know we're experiencing this firsthand. So we know that inflation makes our money less, but what does it do to our stock market investments? Take a look at this video to find out. Hi there, I'm Michelle. Welcome to my channel, where we talk money and having more of it. And in this video, we are going to look at rising inflation and how this impacts our stock market investments. Let's first define what inflation is. Inflation is simply the rise in the price of goods and services, which decreases the purchasing power of our money. Whoa. In plain, simple English, that means the same amount of our money can purchase less of the same goods. This also impacts companies in that the cost of the goods they produce becomes more expensive, while they're also facing being able to sell less to their customers. And this obviously then decreases their revenues and their profits. This makes stock market a lot more volatile as investors try to exit those companies they think will do badly in inflation and enter the companies they think will do better, such as commodity producers. Not all levels of inflation, however, are created equal. And moderate inflation, which can be defined as that close to the Bank of England's target rate of about 2%, may in fact be associated with economic growth, while high inflation could be an indicator that the economy is becoming overheated. Let's take a look at the causes of inflation, how it impacts investor returns, and how we should invest when inflation is on the rise. So what causes inflation? Now, this is a rather controversial point, as economists don't always agree on what may cause inflation at any given point in time. But in general, they bucket it into two different types, being cost push inflation and demand pull inflation. Cost push inflation is generally caused by rises in commodity prices. For example, an increase in the price of oil increases the price of petrol, with the result that all goods and services that use petrol, either for transporting goods or flying passengers, will have to increase their prices, impacting consumers and businesses. A drive to increase wages is also inflationary, as it leads to a higher production cost for businesses. Demand pull inflation, which is regarded as the more common type, is caused when a high level of demand for goods and services encounters an insufficient supply of these. So how does inflation impact investor returns? The objective of investing at its most basic is to give us more money in the future, to provide long-term purchasing power. Now, inflation will erode our investment returns if we are not able to earn a rate of return greater than the inflation rate. Inflation can also be extremely harmful to those investments that provide a fixed rate of return, such as savings accounts or bonds that have a fixed coupon. If the rate of interest we're getting on these investments is below inflation, our investments are providing a negative return. In addition, as we'll get back the money we invested in the future, inflation means that it will be worth less at that point in time. On the other hand, other assets such as equities may rise over time as companies are eventually able to pass on their cost increases by way of increased prices to the consumers. And this would of course depend very much on what the cause of the inflation driver is. So demand pull inflation will facilitate these rising prices a lot quicker than cost push inflation. How should you invest if inflation is on the rise? Firstly, you want to make the most of your money by investing through tax-efficient vehicles, such as your pension and in the UK, your ISA. Secondly, you want to keep a well-diversified portfolio across different assets and industries, and this is made a lot easier if you're investing through funds as opposed to individual shares. Thirdly, keep investing consistently irrespective of what the market is doing. Remember, the mantra is time in the market is better than timing the market. Fourth, consider adding some inflation hedges to your portfolio by way of funds such as an inflation-linked bond fund or a fund with reference to commodities or commodity stocks. Lastly, don't panic. This too will pass, and your investments will live on to face another day and another challenge. But as long-term investors, we don't care, as we are keeping our eye on the long-term goal, which we know we can reach through the magic of patience, time, consistency, compounding, and a steady hand to get us there. If you are ready to face some market challenges, it's important to check your financial resilience. Take the financial intelligence quiz in the notes below to assess how ready you are. If you like this video, please let me know by liking it, share it with any other ladies who want to change their financial story, and comment below if you find anything useful. For financial education and money talk designed for women, subscribe to my channel and hit the bell to be notified of when I post a new video. It's been great speaking with you today, and I'm very appreciative of the fact you've watched this entire video. I look forward to speaking again in the future.